Hey friends, welcome back to the channel. I'm Iggy from the Investing Iguana, your go-to guide for navigating the sometimes choppy waters of stocks, finance, and wealth building. For those just joining us, the Investing Iguana was recently ranked 8th in the 2024 Influential Tigers by Tiger Brokers, with our content reaching over 768,000 reads and 53,000 likes. We've created more than 700 videos with over 300,000 watch hours as of December 2024. Today, we're diving into something that affects every investor at some point, dealing with uncertainty in the markets. Have you ever felt that knot in your stomach when the markets start swinging wildly? That feeling when safe assumptions about where to park your money suddenly don't seem so safe anymore? You're definitely not alone. Most of us operate much better in predictable, stable environments than chaotic, uncertain ones. When uncertainty takes over, anxiety follows close behind. Let's be honest, even financial advisors struggle during these times. They're experts, but they don't have crystal balls. As Lisa Kirschenbauer, a certified financial planner in Arlington, Virginia, puts it, there is no doubt that clients are more anxious than ever. This is not an easy time for advisors, because many norms of investing and economics appear to be blowing up. The truth is, while we'll most likely get through these uncertain periods, it's hard not having all the answers. But here's the thing, there are better options than panic selling when markets get rocky. So today, I want to share some practical strategies that can help you navigate uncertainty without making decisions you might regret later. Before financial advisors can help their clients deal with uncertainty, they need to manage their own anxiety first. It's like that airplane safety demonstration. Put on your own oxygen mask before helping others. One advisor I found particularly interesting is Hazel Secco, a certified financial planner from Hoboken, New Jersey. She starts each day with meditation to calm her mind, which then enables her to help clients stay grounded. What about you? Do you have a morning ritual that helps you start the day with a clear head? It doesn't have to be meditation. Maybe it's a morning walk, journaling, or simply enjoying a quiet cup of coffee before checking the markets. Having that moment of calm can make all the difference when uncertainty strikes. Secco also points out something really important. During uncertain times, people want to find answers, so they pay more attention to outside noise, which can heighten anxiety. Think about it. When markets get volatile, what's your first instinct? For many of us, it's to check CNBC more frequently, scroll through financial Twitter, or read every market prediction we can find. But here's the catch. That often makes anxiety worse, not better. Instead of getting caught in that information overload, Secco redirects her clients' focus to their financial plans. She encourages them to think strategically about the long term rather than reacting impulsively to short-term market movements. This is something I've always emphasized on this channel. Having a solid plan and sticking to it is usually better than making reactive decisions based on market noise. Now let's talk about something that really resonates with me, the feeling of losing control. When markets become unpredictable, that sense of helplessness can leave investors feeling completely adrift. But there's a fantastic exercise that J.W. Harris, a certified financial planner in South Carolina, uses with his clients called the circle of control. Picture this, 3 concentric circles drawn on a whiteboard. The innermost circle represents what you can control. The middle circle shows things you can influence, and the outermost ring contains everything that's completely outside your control. Harris emphasizes that the advisor needs to shift the focus to the innermost circle. The outer circle is not worth your time. Let's apply this to investing. You can't control whether the Fed raises rates or if a geopolitical crisis erupts. You can't control market volatility or inflation numbers, but you can control your asset allocation, your savings rate, when you buy or sell, and your own emotional responses. Focusing on these controllable factors gives you back a sense of agency during uncertain times. Harris also suggests replacing feelings of uncertainty with gratitude. When you recognize what you're thankful for, you have less mental energy to worry about an unknowable future. It's reframing your thought process, Harris explains. It's replacing uncertainty with a measure of control that comes from feeling grateful for what you have. This might sound a bit touchy-feely for a finance channel, but the psychological aspect of investing is just as important as the technical side. Your self-talk plays a huge role too. When faced with uncertainty, it's easy to tell yourself, we're doomed, or all signs are flashing red. But this kind of pessimism doesn't help you make good decisions. As David Shotwell, a certified financial planner in Michigan, points out, uncertainty doesn't necessarily mean catastrophe. Our brains lead us to assume the worst possible conclusion, while reality usually steers a middle course. Have you noticed how often the worst-case scenarios we imagine don't actually come to pass? Our brains are wired to prepare for danger, which was great for our ancestors avoiding predators, but isn't always helpful when navigating financial markets. Speaking of Shotwell, he has 4 principles that govern his investment philosophy, which I think are worth sharing with all of you. In chaotic times, he grounds himself with these core beliefs. First, in the short term, markets are unpredictable. They move based on headlines and emotions, something we've all witnessed countless times. Second, the long term is positive, based on economic growth, productivity, and technology. And these long-term positives outweigh short-term volatility. Third, no one can accurately time the markets consistently. So build a portfolio for all seasons. And fourth, risk and return are forever related. You can reduce your risk, but you also need to reduce your long-term expectations. I love these principles because they're timeless. They were true 50 years ago, they're true today, and they'll likely be true 50 years from now. Having these kinds of unshakable principles provides ballast in a fast-changing world. Shotwell also makes an excellent point about the language we use. It's easier to face uncertainty when we speak and think in objective, rational terms. It's thinking of things as neutrally as you can, he says. Use language in your own head and with others that decatastrophizes so that you don't leap to a worst-case outcome. For example, instead of saying the market's headed for a horrible crash, try it's a challenging time for the market. This more measured way of talking about market conditions can actually reduce your stress levels and strengthen your resilience so you're ready for whatever comes next. Let me share a personal example. Back in March 2020, when markets were plunging due to COVID-19, I noticed myself using catastrophic language in my own head. This could be the end of the bull market for years, or we might be heading into another Great Depression. Once I recognized this pattern, I consciously shifted to more neutral language. This is a significant market event that will eventually pass, and markets have recovered from every previous downturn. This simple change in self-talk helped me avoid panic selling at the bottom, a decision I'm grateful for today. Now let's talk about practical steps you can take when uncertainty is high. First, revisit your financial plan. Is your asset allocation still appropriate for your time horizon and risk tolerance? If you're properly diversified based on your personal situation, short-term market movements shouldn't derail your long-term goals. Second, consider building a cash buffer if you don't already have one. Having 6-12 months of expenses in cash can provide peace of mind during volatile periods. You know that regardless of what happens in the market, your immediate needs are covered. Third, be careful about making big changes during periods of high emotion. If you feel the urge to drastically alter your investment strategy, try implementing a 48-hour rule. Wait 2 days before making any major financial decisions. This cooling off period often leads to more rational choices. Fourth, focus on what you can control, like your savings rate. If markets are down, but you're still contributing regularly to your investment accounts, you're actually buying shares at discount prices. This is dollar cost averaging in action, and it's one of the most powerful tools available to long-term investors. Fifth, consider seeking professional help if uncertainty is causing you significant stress. A good financial advisor doesn't just help with investment selection. They serve as a behavioral coach who can help you avoid costly emotional mistakes. Remember that uncertainty is not the same as risk. Uncertainty is not knowing what will happen next. Risk is the possibility of permanent loss of capital. A well-constructed portfolio accounts for uncertainty by spreading investments across different asset classes that respond differently to various economic conditions. Let's also acknowledge that some level of uncertainty is actually necessary for markets to function properly, and for investors to earn returns above the risk-free rate. If everything were certain, there would be no risk premium, and therefore no extra return for taking on investment risk. One thing I've observed over years of investing is that markets often climb a wall of worry. Some of the strongest bull markets have occurred against backdrops of significant economic or geopolitical concerns. By staying invested during uncertain times, while maintaining appropriate diversification, long-term investors have historically been rewarded. Think about some of the major events we've lived through: the 2008 financial crisis, the European debt crisis, Brexit, the COVID-19 pandemic. Each of these created tremendous uncertainty, yet markets eventually recovered and moved higher. This isn't to say that every market downturn will quickly reverse, but rather that patient investors who didn't panic have generally been rewarded over time. So what's the bottom line here? Uncertainty in markets is normal and inevitable. It's not a bug in the system, it's a feature. The premium returns that stocks have historically delivered over safer investments, like treasury bills, are compensation for bearing that uncertainty. Instead of trying to eliminate uncertainty, which is impossible, focus on building resilience to it. This means having a solid financial plan, appropriate diversification, and the right mindset to avoid making emotional decisions during volatile periods. As we wrap up today's video, I'd love to hear from you in the comments. How do you deal with market uncertainty? Do you have any personal strategies that have helped you stay the course during volatile times? Sharing our experiences can help everyone in this community become better investors. If you found this video helpful, please hit that like button and consider subscribing if you haven't already. For more on understanding the current world crisis and whether it may burst the economic bubble, check out my video on Will the S&P 500 Bubble Burst?, which I'll link in the description. Remember, friends, uncertainty doesn't have to lead to panic selling. With the right approach, you can navigate even the choppiest markets with confidence. This is Iggy from the Investing Iguana, and I'll see you in the next video.